couple of chickens. All right. So let's start off. I'd like to have like a 5-minute make your best case. And so let's start with our bear case, since you're in a minority position. Let's see, Peter, if you can make the bear case. And so the question is, were we witnessing a bull market correction or a bear market rally in the last few months? We've seen a little of both.
Yeah. Well, you know, this is probably the first bull-bear debate in many, many years where I am actually an unqualified bear. I used to qualify my bearishness by saying, hey, the stock market's in a bubble, so, you know, I don't know how big the bubble's going to get before it pops. Well, I think now we know. In fact, I actually think the U.S. stock market entered a stealth bear market at the beginning of 2018. But we didn't officially enter a bear market with the major averages dropping 20% or more until the fourth quarter of 2018. Then the Federal Reserve did exactly what I said they would do the minute the market either entered a bear territory or got close enough to do it to scare the Fed. I said from before the Fed even raised interest rates for the first time that if they ever attempted to normalize interest rates, their attempt would fail, that they could never complete the journey because along the way the market would break and the Fed would have to cut off the rate hikes. And that's exactly what they did. But I also said that the initial calling off of future rate hikes would only create a relief rally in the market. And that's what we've had. This rally is the correction. In bear markets, the rises are the corrections, the opposite of a bull market. So I think the Fed, by throwing the markets this lifeline, has created this bear market correction, this rally. And what I said from the beginning was that the rally would fail because in order to prevent the bubble from deflating, the Fed was going to have to go back to zero. That just stopping at 2% isn't enough. 2% is too high an interest rate for this bubble to survive. The Fed's going to go back to zero. But more importantly, I also said that, and this is from before the Fed even started to shrink its balance sheet, I said if the Fed ever attempted to shrink the balance sheet, that it would have to give up. That I describe it as trying to pull a tablecloth out from under a table and expecting the cloth and the dishes to, or pull the table out from under a cloth and expect the dishes and the cloth to levitate in midair. I knew that it was impossible. So I said if the Fed ever attempts to shrink its balance sheet, it's going to have to stop. What the Fed is going to have to do now is they're not only go back to zero, but they're going to have to stop the quantitative tightening, and they're going to have to reinstitute quantitative easing. That is probably going to happen when the market makes new lows. So when this bear market rally fades and we go for new lows, and of course the economic data is going to continue to weaken, and the economy is headed for a worse recession than the one we had in 2008 because all the problems that led to that recession has been exacerbated by the monetary policy that we've had subsequent to that recession. So when the Fed has to come back and do that, I don't believe that it's going to succeed the way it did in 2001 or 2008, in that the Fed is not going to be able to inflate a larger bubble than the one that just popped. That was the secret to these phony recoveries, was the ability of the Fed to reflate larger bubbles to try to paper over the problems from the last one. So I don't think it's going to be the third time's the charm. I think it's going to be 3 strikes, you're out. I think when the Fed goes back to zero and goes back to quantitative easing, I think the bottom's going to drop out of the dollar, and that's going to lead to a currency crisis and a sovereign debt crisis that's going to be much worse than the financial crisis we had of 2008. And this is not a time to be invested in U.S. stocks or U.S. bonds. The Fed is not going to save you, because when it tries to revive the markets, it's going to kill the dollar, and that's going to destroy the real value of U.S. investments.
Whew. Okay. Wow. Well, I think he made a pretty good bearish case. So let's now turn to Louis Navellier, who's had, well, both of you have been around the markets for a long time. So, Louis, you've lived in bull markets, you've lived in bear markets. What makes you continue to believe that this mother of all bull markets, which we have seen in the last 10 years, will continue?
Well, let me talk to you about interest rates first, since Peter touched on it. even though I'm a stock guy, I have a very big bond business. We raise about $3 billion a year, bundling bonds. They're sold through banks and brokerage channels. But now we have to go to Malta, Uruguay, Panama. I spent a lot of time in Miami. There's this international capital flight underway, and pretty much all that money's coming to America. There's 5 major reserve currencies in the world. You can invest in China, who devalue their currency over 10% to offset our 10% tariffs. And of course, they've had little devaluations before. You can invest in Japan and get no interest. You can invest in Britain, which is uncertain because of Brexit. Or you can invest in the euro, which is now slipping into recession. Italy's in recession. You got the Yellow Vest protests. And Britain is apparently going to pay them to leave. So actually, the euro is weaker than the pound. And, so for people who have money and want interest rates and a firm currency, the only choice has become the dollar. So we have all this foreign capital pouring into America, and that's what flattened stopped the treasury yields from going up. And so the Fed never fights market rates when market rates are coming down. Plus, we have some doves on the Fed now. And so we're in this kind of a Goldilocks era where the rates are stable now. We don't worry about them. And now we focus on earnings. So here's the good news about earnings. So far, they're up 14.6 this quarter. They were up 28.2 last quarter. This is the S&P's earnings. They're going to get harder each quarter this year because the year-over-year comparisons get tougher. But the main reason the earnings have been so good is the stock market continues to shrink. Last year, we lost over $800 billion of stock float from buybacks, highest year ever recorded. And I don't know why they don't report that on the business channels, because that's very bullish. So obviously, you can follow Bernie Sanders or Chuck Schumer and stop the buybacks. Elizabeth Warren wants to do that too. But the truth of the matter, the physical stock market's dying. My average stock will be gone 17 years at the current buyback pace. S&P will be gone in about 27 years. So this is what happens when you have low rates. A lot of companies will borrow at low rates and buy their stock back. But I do expect the market to get more narrow, more fundamentally focused this year. Totally different leadership this year. We have the energy's got best earnings next couple quarters, followed by especially retail, the Lululemons, the Burlington stores, Ross stores, then followed by healthcare, medical, and then finally by cloud computing and cybersecurity. So as the market's more narrow, we expect this to be more of a funnel. The market will lose breath and power, but if you can identify the winners, you'll be fine. So we expect a very selective market. There are risks to the market. We saw them last year, and they came from the ETF industry. In February of last year, the market crashed because they invented something called an exchange-traded note that you could buy to protect your portfolio. The only problem is it fell at 90% in a day. So they had to unwind all that. So the February correction was literally caused by a bad ETF products. The correction in the fourth quarter was caused by widening spreads in ETFs. And we manage ETFs. We're in the process of selling that business now because we've gotten so disgusted with it. And we're out of all the stock ETFs because the spreads are still wide. They're cost prohibitive. We're hiding out in Treasury ETFs, profiting from these low rates right now. But the truth of the matter is when you buy and sell an ETF, you don't realize how much you're being fleeced. And I've written a lot of articles on this, but you buy a blockchain ETF, plan on being fleeced 15 to 18% per day when you buy it. A pod ETF, 30 to 32%. So what's happened is there's big ETFs out there like DVY, the iShares dividend, SPY, the SP 500. Do you know SPY last year went up 13% after market hours, but during market hours it fell 17%? It's actually a 30.3% performance difference. So we have a managed ETF business, because if you buy ETFs during the day, it's wrong. Wall Street invented a new thing for you. It's called no transaction pricing for ETFs. TD Ameritrade is example one. Do you know what no transaction means? That means we're going to F you on the spreads. If you sold on Christmas Eve, you would have lost 4 to 6% below the value of the stocks. So we're monitoring this. This is like an EKG for the stock market. And this was the glitch last year. But fortunately, good stocks bounce. We've seen the bounce, but it will get more narrow. But there are continuous risks out there we continue to monitor. And so this will not be an indexing year. It will be a very selective year. And I just think you have to be in the creme de la creme. And that's why we give you all our stock grading, all our research online free.
Okay, I think that's a good introduction to our the differences between the two, the bull and the bear. There is a question I want to ask Peter to start off a little bit of our exchange, and that is a quote from Bertrand de Jouvenel, who is a French philosopher, quoted in the Maxims, and he said, "A forecast is never so useful as it warns man of a crisis." And certainly that quote would apply to your great call in 2007 that we are headed for a major financial crisis. And you've kind of hung your hat on that, but that was 10 years ago. Did you also predict, Peter, that we were going to head for a mother of all bull markets? Isn't it true, Peter, that you were predicting a mother of all bear markets over the last 10 years, and you missed this major bull market?
Well, first of all, my prediction of the financial crisis didn't start in '07. I was predicting it in '01, '02. The minute Greenspan lowered interest rates to 1%, I knew that this was going to create a problem.
That was 2004.
No, they slashed it, they slashed it maybe in '02. They really slashed it down there. And so I didn't just call it right in time. It had been several years before it blew. I was coming to the Money Show for a while, warning about that problem before it blew up. And then, once the Federal Reserve did everything that I said that they were going to do, the only thing that I got wrong is I thought the Fed was going to attempt to reflate the bubbles. And in that attempt to reflate the bubbles with cheap money and lower interest rates, that the dollar would tank and that would end the party prematurely. What I got wrong is that the Federal Reserve didn't attempt to reflate the bubbles. It actually succeeded. Something I didn't think they would do back in 2007. They actually made the bubble bigger, and so therefore the problems, instead of getting solved, were simply exacerbated. And so now the crisis that I believe we've postponed is now going to be much worse. And of course, politically, it's going to be a disaster based on the agitation for socialism that's going on. But I wanted to just correct one point, the way you framed the question to Louis. You said, will this longest bull market in U.S. history, will it continue? That's not a question anymore. That bull market came to an official end in December of last year. We are in a bear market by definition. So the question is, are we in a new bull market, or are we still in the bear market? And I think it's really a stretch to believe that the biggest bull market in U.S. history, the longest bull market, would be followed by the shortest bear market in U.S. history. I think you have some proportionality. I think the booms are proportionate to the busts, and we had the mother of all bulls, and it's going to be followed by the mother of all bears. We're going to have the mother of all economic hangovers from the biggest dose of monetary stimulus the Federal Reserve has ever injected into the economy. If we got the financial crisis of 2008 based on 1% interest rates for a year and a half, and then maybe a couple of years before they got back to 5.25%. Imagine the damage that the Federal Reserve has done to this economy with 0% interest rates for 6-7 years. It took 3 years now to get them back up to 2%, and that's it. And all this quantitative easing, all of the debt, Louis talks about the debt. Corporations have taken on a massive amount of debt. Individuals have taken on a massive amount of debt. Credit card debt, record high. Student loans, auto loans. The government is awash in debt. $22 trillion national debt. $100 billion a month budget deficits. We're running bigger budget deficits now on a monthly basis than at any point during the Great Recession. So we have all of this debt, and this is going to end with a shallow or a short bear market and a soft landing. I mean, anybody who believes that, is smoking some of these pot stocks, the pot that's so overvalued. But anyway, so that's what I wanted to point out.
Yes, and that's a very good point. So, Lou, he raises an interesting question. Technically, did we see the end of the bull market, the 10-year bull market, with the last quarter, despite the rally that we've seen in January, which, by the way, was the biggest rally on Wall Street in 30 years in January. But of course, that's
The
very
worst
typical.
December since 1931.
So you have a real flip-flop
Yeah.
on that. So technically, are we still in a bear market, or I mean, the Dow's at 25,000.
Yeah, well, yeah, technically it hit the bear market level, which is 20%. And then not only did we have the best January in 30 years, we had the best small cap rally in 42 years. So, as January goes, the year goes, but it'll get tougher. It's going to get tougher, and it's also pension funding season. Markets are seasonally strong through April 15th because a bunch of money comes in. Just people fund their pensions. So they're going to turn that faucet off, and that's the reason it'll get a little bumpier.
Yeah,
But whatever we were worried about, we're not worried about anymore. The CNBC misled you on interest rates. They said the Fed would hike a lot more than they did. They didn't. They're done. We have doves now on the Fed. Powell met with Trump a week ago. Actually, this week. I'm sorry, Monday this week. It was 66th birthday. Then everything's fine now. So we have a very stable interest rate environment. We have Treasury auctions this week. The auctions there's something called bid to cover ratio. As long as there's plenty of bidders, yields don't go up, and the bid to cover ratio is okay right now. So that's when it will break, is if there's no bidders. But because we're better than Europe, Britain, China, and Japan, all the other major reserve currencies were fine. So, what the real long-term goal, and he didn't say it specifically in the State of the Union, he wanted a record number of immigrants come to America. You want to turn America into some economic free enterprise zone for the world, but you just have to have them pay taxes and all. So, we're still going to be fine. I'm not worried about America. I'm not worried about the direction of the country. I'm not worried about the debt.
Lou, that
the
Peter
debt
keeps talking about the debt across the student loans.
Yeah.
$22 trillion national debt, corporate deficit. I mean, is this a problem?
Well, you have to address each one. The student loan problem's a problem. It obviously hurts millennials buying homes.
They're not buying homes anymore.
Well, that's
They're tending bar.
That's right. So we have that. It has affected the housing market. There's a subprime model loan problem.
They're not even buying cars, by the way.
Yeah, millennials are a little confused. Okay, they think apps control the world.
They can't even rent apartments.
Okay, yeah, they're a little confused. And there's a subprime model loan problem right now. But the household debt's not that bad right now. You'd be shocked how much mortgage debt was paid down. The federal deficit's not a problem because there's plenty of bidders for the debt. So the only issue right now is demographics, and we're getting older. We're going to slow down. The fastest growing state in America is Utah, and Utah's a little different than we are. They have a lot more household formation. They're a lot younger than we are. So you do want to have orderly legal immigration. You do want to get the median age of country down. But there's a lot of things. Like look at energy now. We control the world oil market. We produce more than Saudi Arabia and Russia. We're reversing all these natural gas pipelines to transport more oil. They got to put a liner in it, and we're going to put another 1.1 million barrels a day in production this year. And so oil's not going to go up anymore because we control it. Okay. And that's why we can tell Venezuela to go, we don't want your oil anymore. It's just sitting offshore there.
Speaking of Venezuela and the socialist popularity that seems to be coming into America, isn't this a bearish sign that possibly we will see more legislation that could really hurt us?
I mean,
It is a possibility.
Look, there is tremendous unappreciated political risk in U.S. investments. I mean, if I'm right about the economy and what's going to happen politically in 2021, confiscatory type of corporate tax rates are coming. And also, if you look at these new plans to not only limit buybacks, but limit dividends, to actually pass legislation that forces companies to put the interest of workers and other stakeholders ahead of the interest of their owners. That owning a stock, you may not get any return on your investment until the workers are given what the government somehow believes they're entitled to. But I wanted to make a point, too, about this big rally in January. Bear market rallies are notoriously big. Some of the biggest rallies in the stock market history have come during bear markets. One of the reasons that the small caps rallied so much was because they were down so much. The Russell 2000 was down like 27% from its peak. And so, yes, it had a bounce, but it's nowhere near the highs. It still technically is in a pretty big bear market. And when you're talking about the debt, Louis, and you're saying, oh, it's okay, it's not a problem because we have it covered. First of all, the bid to cover ratio has been coming down rather substantially. But just because people are dumb enough to loan us money today doesn't mean they're going to do it tomorrow. I live in Puerto Rico, and not too many years ago, people were dumb enough to loan Puerto Rico tens of billions of dollars. I mean, hedge funds were buying Puerto Rican debt, smartest guys, even a few years ago. They were lending money, and now they're broke, no one's getting paid, right? It's a crisis, because it's never a problem until it's a problem. But once it's a problem, then it's too late to do anything about it, which means it's always a problem. It's just nobody wants to admit it until it blows up. And we have the mother of all debt bubbles in this country, and we're not too far from the breaking point.
So, Louis, isn't there a problem if interest rates are rising, which they are doing, that the national debt, while wasn't mentioned in Trump's State of the Union, he completely ignored it. Couldn't that become a real big elephant in the room when interest rates keep going up?
It will, but they're not going up now because there's worldwide capital flight. So to America, so they're not going to go up. And then, thank God, you spend time in California, so he can always, sell El Toro. He can sell Moffett Field. He can sell the Alameda Naval Air Station. And, I don't think he's going to sell the national parks yet, but, it's...
There's lots of assets.
There's some collateral there, you know what I mean? But that California real estate I just mentioned is probably worth some... You'd always make the Presidio condos, That's a nice piece of property.
Sell it to who? Chinese?
You're describing a bearish scenario where they panic.
Well, they don't have to do it because the foreign capital keeps... Every time
That can turn on a dime, Louis.
It can, but it hasn't. Okay, listen, I know California's fiscally responsible. I'm from there. But let's go back to this dividend, the dividend and buyback thing. They're not going to get rid of that. Okay, I'm from Berkeley. I'm fully trained in socialism. Every single business school teaches Finance 101 is you finance with debt or equity. So when your P ratios are low, you finance with debt, and then when your P ratios are high, you finance with stock. And the reason you don't see stock offerings anymore is P ratios have been compressed relative to interest rates. So you can go, Micron Technologies in Boise, Idaho, it hit 3 times earnings, and it buys its stock back. The bottom line is P ratios are not high versus interest rates. Okay,
but
there's a teeter-totter in stocks and bonds.
But if interest rates are artificially low, I mean, in a free economy, interest rates are only low if you have a lot of savings, and then that's you have a large supply of savings, and people don't have a time preference for consumption. People want to defer consumption into the future, so you have a lot of savings, and so you can have low interest rates, and then you can have a lot of capital investment. But America, we have no savings. Nobody is saving any money. The only reason interest rates are low is because they've been artificially suppressed by central banks. So don't you think if interest rates are being artificially suppressed, that is sending false economic signals, and that lots of debt is being taken on that shouldn't be taken on, and businesses are doing things that cannot be sustained, and that ultimately interest rates have to rise to reflect the lack of savings in the United States? And when that happens, isn't this whole bubble going to implode?
All right, final question, then we're going to get into...
But let me be very clear. It's not our central bank, okay? I will agree with Peter that Europe prints money, it's called quantitative easing, to buy corporate debt, and Apple runs over to Germany, sells 9-year notes for 70 basis points, and takes that cheap money to buy their stock back. I will admit that, okay? But our central bank is much more responsible, okay? It's what happens when a society gets old, Japan, Europe, they can't raise rates. They're never going to raise rates in Japan or Europe, okay? So the bottom line is you look around the world, America has higher rates, stronger economy, we are younger, immigration does work better here despite the controversy, and so capital's flowing here. So there's not a problem now. I don't see a problem down the road, but we're going to be fine.
Never say never. Rates are going to go up in Europe and Japan.
We have 5 minutes, and we want to get into some specifics. So let me ask by the first question, which is going to be a better investment over the next couple of years, gold or stocks?
Well, it depends. If you're talking about U.S. stocks,
Give me this,
no, you said stocks. And first of all, there are also gold stocks, which I think.
Well, that's what I meant.
Right.
Of course,
But
yes.
no, but I think physical gold bullion will outperform the U.S. stock market, not just for the next couple of years, but over the next decade, maybe longer. Not because gold is a great investment. Gold is a store of value. And there's going to be tremendous inflation as a result of the attempts, not just by the Federal Reserve, but by other central banks, to keep interest rates artificially low because there's so much debt. There is a cost to that, and the cost is inflation and the destruction of the value of fiat currencies in general, not just the dollar. The question is which fiat currencies will lose more value in relation to others. And so there are other currencies that I don't think will do as badly, but I think gold is going to rise in all currencies. So I would rather own gold than U.S. stocks, but I believe that there are stocks in other parts of the world that are going to benefit dramatically from a collapse in the value of the dollar and the relief that will provide to a lot of economies that have lots of dollar debt that is basically going to be wiped out. And as Americans stop living above their means, that means a lot of countries no longer have to provide the subsidy to the United States that they've been providing. So I think that there are going to be stocks that are going to do really well. In fact, I'll be talking about that at my workshop at 5:30 later today, 5:30 today. Right. So make sure and be there, and I'll get more into the way you make money in a bear market like the 1970s. People forget that the stock market peaked in 1966 at 1,000, and it didn't get above 1,000 until 1982, and there was a tremendous amount of inflation during those 16 years.
We have 1 minute.
Well,
Stocks or gold?
No, I mean, listen. I can find dividend growth stocks that yield about 3.8. They double dividends every 6-7 years, things like Boeing. They buy their stock back. They got a record order backlog. I have no problem getting good dividend yield with my growth. Obviously, I'm a stock picker. I'd rather be in that. When you have a strong dollar like we do now, it suppresses all commodity prices, including gold, because commodities are priced in dollars. So we have deflationary forces underway now. You saw it in the CPI and the PPI in the last couple of months. That's another reason the Fed can't raise rates, because they don't want to promote deflation. But the strong dollars shove down commodity prices. But yeah, the world will end one day, and I don't know if gold will protect you. Just not to scare you, but we have no sunspots. They've been gone for a couple of years. A lot of people think we'll have a Marauder minimum, which is a mini ice age. It's only going to last 70 years. And then what is it? Oh yeah, the planet's going through the part of the Milky Way with a lot of asteroids, and we just had a big one over Cuba. So there might be an extinction event, but other than that, everything's going to be fine. And I'm not sure gold will protect you during that event, but I'm not going to worry about it. My best defense, strong offense, and so I'm going to stick with my best high-quality stocks.
So, ladies and gentlemen, by the way, on income investing, I agree with Louis on that. We have some really excellent choices. I'll be talking about that today in my workshop at 11:15 on the Flying 5 strategy on income investing that can beat the market.
But the foreign stocks provide even better income in currencies that are going to go up.
Well, that may be possible. So foreign investing, we didn't even have a chance to talk about China, which can be a major issue here on whether we have a bull or bear
They
market.
got a demographic problem there too. They only have one baby and they wonder why they're so old now. Yeah.
So let's see how well we did. So this is an Oxford-style debate. At the beginning, we asked you what side you're on. 2/3 of you were bulls, and 1/3 of you were bears, and maybe a few chickens among the group. So by show of hands, how many of you switched from being a bear to being a bull from Peter to Louis' side? Show of hands, how many switched?
Oh.
Okay. All right, I lost one
Okay,
guy.
how many
I lost
then?
one guy.
Switched from being a bull over to being a bear on Peter's side. Show of hands.
Oh,
Well, it looks like a few hands went up.
Yeah,
So
okay.
according to the Oxford style, even though most of you, and of course, when more bulls are there than bears, it is a tougher thing to win this debate. you
Yes, I understand. I
Yes.
understand.
So let's give a big applause for both of our debaters.